I think it's probably more related for Thomas, is regarding the residential and student housing market. Like, I want to understand a little bit more about his experience on that, and if he's seen the same crazy yields Philip was mentioning before, like 18 times multiplier, and if so, eventually, if it's like the case for him to start move to more secondary locations for those sectors as well. Thank you.
Yes, I think we have to see two things. On the one hand, let's say the 7 big cities in Germany and new developments. These are the typical products for risk-averse investors, pension funds, insurance companies, and so on. There, your yield is below 5%. Your gross yield is below 5%. So you're paying in Berlin 22 times. I don't want to talk about Munich. So your gross yield is, I don't know, 4% or something like that, even lower sometimes. So I think on that end, in my eyes, it's really overpriced. On the other hand, it's not as crazy as what we have seen prior to the Lehman crash. I mean, then we saw really 15 times for really C locations in North Rhine-Westphalia or in East Germany, and we saw a leverage of 95%. I mean, that was really crazy. This is not what we see today. What we see today is that a lot of resi investors are going to invest also in B and C cities, and we see some new players, also stock-listed companies investing in very diversified portfolios, which was the problem a few years ago. There, you could only sell portfolios within a certain region because they have their asset management team and their property management team. But now we see some investors who are in a position, or they think that they are in a position to purchase diversified portfolios and can manage it. So what we see, it's not as crazy as what we have seen. I mean, at the moment for these diversified portfolios, you pay, let's say 12.5 times, so it's an 8.5% gross yield, and with the 8.5% gross yield, you can dividend out, let's say 4.5 or 5% as a long-term investor. But you have to keep in mind that this is not the really nice product for your brochure, so you have to and this is the problem. On the other hand, for the German insurance companies and pension funds, they would like to have a 5% dividend yield, which is still possible in the German market, but they don't want to go into B and C locations. They try to find that product in the big 7 cities, and this is the reason why we have seen that yield compression. But if you are, in terms of your investing model, okay to go in these locations, it's still possible to purchase at an 8% gross yield.
Thank you. Did you see something similar on the student housing market?
On the student housing market, honestly speaking, there is not a huge existing stock. So when we talk about student housing, we talk about new developments or newly erected buildings. And they are also, I mean, I remember when we started that student housing business 3 or 4 years ago, a lot of people said, wow, it's like a hotel, it's a managing problem. In my eyes, it's resi with a higher fluctuation. So it's easy to manage if you have 10 different things in mind, and if you have managed 3,500 of these units, it's not rocket science, honestly speaking. But when we talk about newly erected buildings, also for student housing, you're talking about multiples between 16 and 20 times on existing rent.